Kitco Mining special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Sprott continues to add ETFs with a bullish look on commodities. This is Paul Harris of Kitco Mining and the BMO Metals Mining and Critical Minerals Conference in Hollywood, Florida. And joining me today is John Ciampaglia, CEO of Sprott Asset Management. John, welcome back to Kitco.
Thank you for having me back.
Now, let's start with uranium. Uranium had a great 2023, and the outlook continues to be positive with the number of nuclear reactors worldwide hitting record levels. It seems your timing to launch the Sprott physical uranium ETF a couple of years ago was spot on.
Yeah, well, to be totally honest, we've been working on that uranium vehicle since 2019, which was obviously early, but we're very pleased with the way the trade has played out. Our thesis has played out very nicely. Again, this is a very unique commodity that is still operating today, even at almost $100 a pound, at a primary supply deficit. And I think the story has evolved enormously over the last 3 years from a commodity that was in a supply deficit to a commodity now that is being recognized for its importance for three major goals: decarbonization, which the world is increasingly focused on; energy security, which unfortunately 2022, we all learned about that; and finally, it's the perfect complement to renewable energy, which is being added in record amounts around the globe.
In terms of the uranium price, do you foresee that it will keep on rising, or is it going to stay and consolidate around these levels?
Yeah, I mean, we've had a really strong move in the uranium price, and it's really reflecting the fundamentals that I just laid out. You've got this increasing demand for nuclear energy around the world as countries try to achieve these three main goals. And then you basically have an industry which is largely suffered a lost decade, as I like to call it, in terms of very little development, exploration. With every commodity cycle, when higher prices are achieved, you get a supply response. We're starting to see that in the uranium sector with a lot of restarts, mines reopening, but it's going to be a very slow and I think bumpy process. So we don't see a real meaningful supply response coming for the next few years. And in the absence of that, we think uranium prices are going to be higher for longer.
In terms of your comment there about the supply response, I'd like to dig deeper into that, because listening to some of the rhetoric about clean energy and nuclear's role in that, it seems people are perhaps confusing what nuclear power actually is, because at the end of the day, it's baseload power, it's not swing power. You don't have Homer Simpson with a lever to more or less to adjust to the demand on minute per minute, hour by hour. You need that baseload capacity. That's not going to be the variable load, is it?
Yes, and that's why it's so important, is that it is on all the time. The capacity factor for nuclear energy is 92.5%. If you compare that to, say, solar energy, which the world, as I mentioned, is building huge amounts of capacity, is about 25% of the time. And I think countries realize that they need to have a diversified source of energy production in order to have a stable grid, a stable economy, and affordable energy prices.
Now, there's been a lot of talk in the Western world about critical minerals and access to supply. And obviously, a large amount of uranium comes from nations that, how shall I say, perhaps aren't the friendliest towards the Western world. How much of an issue is that in reality?
Yeah, it's a big issue. I think it really compounds the whole uranium story. Because if you look at where uranium comes from today, 75% of it is produced in Kazakhstan, Uzbekistan, China, Russia, and I'm going to add in Niger because they're in the middle of a coup and production there has been shut in. So it's a very concentrated supply profile, which makes it more vulnerable to shocks. And I think the West has realized that they need to incentivize the reshoring of a lot of supply chains. Uranium mining is one of them. And I think it's really positive to see that a number of previous producers, not just in the United States, but in Canada, Australia, Africa, are finally getting their uranium mines back online to help balance the supply profile.
With the uranium price on an upswing, the number of uranium junior explorers has exploded. It's quite unreal. To what extent do you look at the junior end of the market? And I guess the path for a junior to actually define a resource and get towards, but that's very, very difficult. Very few do it. Even though the price has gone up, there's very few that are making that leap from a, let's say, development stage project to actual production.
Yeah, there's been a growing interest in junior mining in uranium in the last, I would say, since August. With respect to the Sprott Junior Uranium Mining ETF, we've seen quite a bit of inflows, and more recently, it's been our number one selling fund at Sprott. And the reason for that is people are excited about this higher uranium price is sufficient enough to turn on a lot of idle capacity. In some cases, these mines have been closed 5-6 years, sometimes 15 years, these mines have been closed. But with uranium at $100, it's now allowing these companies to come back online. More importantly, for the exploration and development companies, they have a fighting chance to actually raise some capital and move their projects down the pipeline. And that's really critical to these smaller cap companies. So, yes, there's going to be a lot of winners and losers in the group. So you have to kind of be careful about how you invest. There's obviously a lot of early stage companies that have a very long road ahead of them in terms of ever coming to production. But with commodity price at $100, it really gives these companies an opportunity to move forward after a lot of years of doing nothing.
A lot of the juniors, their ultimate goal is to be acquired by a bigger company, but I think it's the case certainly in the uranium space that a lot of the big companies, as you mentioned, they've got idle capacity that they can now bring on, and so their need to acquire somebody else or another deposit is perhaps limited.
Yeah, I don't think we're quite at the phase of the bull market where you've got very active M&A activity. Where we are basically, we're in the recovery mode. The recovery mode is really about turning on all the mines that have been shut in. And that's where the Cameco's of the world and obviously the Kazakhs have been trying to focus on flexing production. Boss Energy, Paladin, all these companies that have had previous producing mines are very focused on getting back to production. I think as the bull market matures, you'll see a wave of M&A. We've seen pockets of it, but I think it's still to come.
Okay. Well, let's switch track, John, if I may. Let's talk about gold. Sprott's obviously got gold ETFs. We're here at the BMO Metals and Mining event. We've had the privilege to speak to a lot of gold companies. And one of the things I hear often is how gold ETFs have killed investor appetite to invest in individual stocks. However, the performance of a lot of stocks hasn't been very, very good over the recent years. How do you see the environment?
Yeah, well, I think you have to view them as two separate investments. They're very different. If you think about investing in funds like our physical gold trust, PHYS, you're buying a commodity with very unique attributes. It acts as portfolio insurance. It acts as kind of the ballast in your portfolio. Gold stocks, on the other hand, are stocks. And what we find is that they tend to have moderate levels of correlation to just general equity markets. And obviously you're taking on very different risks when you're investing in gold stocks, whether it's geographical risks, operating risks, or whatever. So they're very different animals. Clearly the gold stocks have struggled the last few years. I think it's really been a function of cost inflation has been quite significant since COVID. A lot of supply chain disruptions, cost of labor, all of those things have hurt the bottom line. And companies at the end of the day, they need to produce gold and they need to replace reserves. And that's really what ultimately drives value. So we hope the gold stocks perform better. I know a lot of our investors are frustrated with the relative performance between the two. But again, at the end of the day, I think you have to think about what role each plays in your portfolio.
Do generalist investors not want to have to investigate individual companies and their mines? They don't want to get that level of expertise in detail. Is that why they turn to the ETFs?
Yeah, I think for a lot of investors, they don't have the commitment or the skills or the confidence to pick through individual companies. Obviously, there's more individual company risk if you're going to pick one or two. And even in a bull market, you get winners and losers. So they're reluctant to maybe pick the wrong one. Why ETFs, I think, have been very popular. And now we're, I think, $11 trillion worldwide. And gold stocks and mining stocks in general have been very popular for ETFs because investors say, look, I like this thematic. I'm just going to buy a basket of them. I'm going to diversify across a number of companies, countries, projects. And that's a way for me to mitigate individual company risk.
Recent years have seen a few mega deals in the gold space. one of the arguments for that is consolidate and create vehicles that are more appealing to generalist investors because they are bigger. But those companies have tended to underperform, and so presumably that damages the view on the rest of the sector or the rest of the gold equities.
Yeah, I mean, I think the need to get bigger is real. You might say, well, are people getting bigger just for the sake of getting bigger? No. They are getting bigger because they want their companies to be more meaningful, larger market cap, higher liquidity, so that they're more appealing to larger institutions. Now, at the end of the day, you need to find the synergies, you need to find the value, create the value by coming together. Some of those historical transactions have worked out well, others have not, and that's kind of the way it goes with M&A. They don't always work, but I think there has been a profound shift in the markets the last few years around bigger is not always better, but it has an advantage in terms of liquidity and scale.
I agree with your basic premise there, John, but given the complexities of running mining operations, multiple projects over multiple jurisdictions, is there potentially an aspect of, getting too big to be able to succeed?
Yeah, it's a good question. I don't know. I don't really have a good answer for that, but I think generally we have a lot of mining companies. Getting bigger and more relevant to more investors, I think, is a big challenge for many of them. We often, run into institutional investors that tell us they're not allowed to buy market cap companies below $5 billion, for example. So that really excludes a lot of the universe. And it's a challenge to stay relevant in a world that's, I think, becoming increasingly focused on liquidity and size.
Okay, let's talk copper. You recently launched a copper ETF. Tell us about that and your outlook for copper.
Yeah, sure. So copper is another mineral that we think is underappreciated and underowned, and it's going to play a key role in electrification. Copper has so many different applications, whether it is just different industrial uses, but it's growing predominantly because of energy transition. So that is greater electrification, whether it's solar, wind, electric vehicles, transmission grids, wiring, cabling, you name it. Copper is kind of your constant backbone material. And so we think the world will need significantly more copper in the coming decades. We've been mining copper for thousands of years, which means we found all the easy stuff. We've been mining copper, and what we are finding is that the grades are falling. We need to find more larger ore bodies and a lot of investment, and these projects are very big. So we think there's going to be tremendous long-term durable demand for copper. We think investors are we're becoming increasingly interested. I noticed the poll this year at the conference was, what commodity you think will have the most attractive prospects? And I think copper and gold were the winners this year. Last year it was copper. Copper did very well last year on a relative basis, and I say well, it was basically flat for the year, but compared to a lot of other commodities that sold off, it did very well, and that's because energy transition related demand is really holding up the price.
And it sounds like you expect copper to have a price breakout similar to what uranium experienced last year.
Yeah, there are a lot of similarities between what we're seeing in uranium and what we're seeing in copper, where you basically have a projected supply deficit. You need to find more supply, and the only way to do that is significant capex, which is only going to come if you see higher prices. So longer term, we see better copper prices, we see more interest coming into the sector, and so we launched a ETF in the United States that focuses on junior copper miners because we think there's a lot of interesting prospects in that space and M&A activity potentially. We also launched a similar fund copper mining ETF in Europe recently, and we are trying to expand our overall offerings in the copper space this year.
How did you populate that ETF? Because with all due respect, there aren't that many copper explorers or developers out there. So there's many fewer companies than in the gold space, for example. How did you populate the ETF?
Yeah, it was not easy. You might think, copper is a huge market. It's $200 billion a year. There's all kinds of copper companies. The reality is it's hard to get pure play exposure to copper because if you look at the top 10 copper producers in the world by volume, what you will find is that most of them are either privately owned or they're part of diversified mining companies that predominantly produce things like iron ore and coal. So you're not really getting that pure play exposure to copper. So when we built our index in partnership with NASDAQ, we went company by company. We went into the balance sheets and income statements to see what were the revenue profiles and assets related specifically to copper. And so each company needs to have a minimum threshold to be included in our index. And it's a dynamic process. Every 6 months, we basically rebuild the whole index because the market's changing a lot. There's been a lot of spin-outs. There's been a lot of M&A. Companies clearly are focusing on copper as a strategic asset. We want to make sure our index is evolving with the market. So we're taking our knowledge at Sprott as active managers and injecting that into how we're building our passive indexes.
Fascinating. John, what are some of the key things that you're looking out for, looking forward to this year?
Yeah, well, we would love the narrative with the Federal Reserve to shift. I think it's taken a lot of oxygen out of the room, particularly with commodities and precious metals. I don't think people realize that there's $6 trillion sitting in just US money market funds, collecting 5% interest. A lot of that capital, I think, will eventually come back into the market, and some of it, we hope, comes back into commodities and mining. So that has really taken a lot of capital away from the markets the last 2 years. And we think the Fed is finally done and is going to start to pivot. So we expect things like gold and silver to perform better as interest rates finally come down. I think uranium is going to continue to attract the lion's share of attention. It's a very interesting market. Why? Because the demand for uranium is completely inelastic. It's unlike most other commodities. And then I think copper is going to be the slower emerging story that is going to play out for the coming years.
Well, I look forward to catching up with you at some point later in the year, John, to review some of these things. John, thank you very much for joining us today.
Thank you for having me.
Kitco Mining's special coverage of BMO's 33rd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.